Exercise 1620, the full statement of cash flows. So the income statement and additional data of Supplements Plus Incorporated are in these boxes. Let me widen my window. So here's our income statement, and here's our additional data. So we start off with the operating activities section, and as you hopefully remember, the operating activities has net income, depreciation, gains, losses, and changes to current assets and changes to current liabilities. And then here are all the video links in case you need to review those about why they go where they go. All right, so the first thing we need is net income. That, of course, comes from the income statement. So our net income is positive $53,000. Okay, next, according to our cheat sheet, we do the depreciation. Now the order that they go on, the order that they go in does not matter, but they need to all go in the proper section. And right now we're working on the operating section. So we need our depreciation expense of the plant assets, $25,000, and the rule is we add that. So we're going to keep it as a positive number. Next on our cheat sheet are gains and losses. Gains and losses would appear on the income statement. I do not see any gains or losses, so we will skip them. Next, we're going to analyze all the current assets and then all the current liabilities. So we don't need the income statement. We do need the additional data, which is right here. So I'm going to use my cheat sheet to block these off one at a time. Notice the data up here is for non-current assets. In other words, liabilities, plant assets, and equity. So we're going to go down here and start with the first non-cash current asset. So AR, now notice this is the old year, previous year, and this is the current year. So it looks like AR went down. So if AR decreases, what must have happened? Well, we must have collected on AR, and if we collect on AR, which way does cash go? Cash goes up. So we're going to add that difference and double check your rule. Decrease in current assets, you add. Decrease in AR, and then we're going to add that $16,000 difference. Next, we've got our inventory. Looks like inventory increased by $5,000. So if inventory increased, what must have happened? We must have purchased inventory. So if we purchase inventory, what happens to cash? Cash goes down, so we subtract that, minus 5,000 increase in inventory. And if you double check our rule, increase in current asset, we subtract. Next are plant assets. Now plant assets are not a current asset, so we skip them. Accumulated depreciation, that's a contra asset that goes along with plant assets, so we skip that. It's not a current asset. And land is not a current asset, skip that. Now we got to analyze our current liabilities. So it looks like AP increased by $16,000. So the rule is if there's an increase in current liabilities, we add. So that's going to be a positive 16,000. Increase in AP. Next, we've got, looks like a decrease in accrued liabilities. The most common, remember, accrued liabilities are liabilities that have accumulated but not yet been paid. The most common one is salaries payable. So if our salaries payable decrease, what must have happened? Well, we must have paid off the liability. So if we pay off the liability, what happens to cash? Cash goes down, which is why our rule says a decrease in current liabilities, you subtract from the cash. Looks like it went down $6,000. Decrease in accrued liabilities. Okay, And now there are no, well, let's just double check. Notes payable are long-term. Common stock is an equity. Retained earnings is equity. So we're done analyzing current assets and current liabilities. And notice we are now done with the operating section. So our next task is to sum these. And we should get positive $46,000. And then we're going to add that to the $53,000 and we get $99,000. So because this is a positive number, that means we have positive cash flow from operating activities. That's very good. All right, now we're doing the investing activity section. So what goes investing activity section? Changes to long-term assets, but only if they involve cash. Remember, this is the statement of cash flows. And here's another way to look at it. Investing cash flows are only changes to long-term assets. So what we're going to do with our list here is we're going to go through them one by one and see if they have an effect on long-term assets. And if they do, we have to include just the cash portion. So the first one, we acquired plant assets, $121,000. But not all that was cash. Of that amount, $104,000 is paid in cash and the rest by signing a note payable. So this $17,000 is an investment with financing. So that's a non-cash investing in financing. So if my accounting lab allowed us to go to that section now, we could go there and put it, but it does not. So we will put that in there towards the end of this exercise. So let's get back to what we're doing now. We're doing changes in long-term assets, but only if they affect cash. So we acquired plant assets, and the amount that was cash is $104,000. So since we acquired plant assets, we must have paid that $104,000. So that's a minus. Cash payment for acquisition of plant assets. We can't use the acquisition of plant assets by issuing notes payable because that's non-cash investing and financing. That goes in a different section. All right. So what we're going to do now is keep going through our list, see if we have any other long-term assets that were affected. Cash receipt from sale of land. All right, so land is a long-term asset. All right, so this accounts since we got cash. I should say this goes in the section. And also it says there is no gain or loss, which we knew because there was no gain or loss on the income statement. So cash receipt from sale of land, since we received cash, is going to go in as a positive. Cash receipt from sale of land. And then what we're going to do is we're going to go down our list and see if there are any other long-term assets that are being affected. Common stock, no, that's equity. Notes payable, that's a long-term debt. Payment of dividends, that's affect retained earnings, which is an equity. So we are done with the investing section. So what we need to do is we need to sum these, and we get minus $78,000. So we have net cash used for investing activities. So what the company is doing is it's investing in plant assets. Net amount is $78,000 cash being paid. So it's nice to see the company investing in itself. All right, now we're going to do the financing section. So what goes in the financing section? Right here, changes in long-term liabilities and changes in owner's equity. Now notice, you can also look down here, we have the rules, changes to long-term liabilities, changes to equity. So you can use this or this, whichever one works better for you. So we're going to look for changes to long-term liabilities and changes to equity. Now remember, this has to involve cash. So starting with A, we've got this $17,000 for a note payable, but we did not get cash. So it does not go in the financing section. That goes in non-cash investing and financing. Cash receipt from land, that's a long-term asset. Cash receipts from issuance of common stock. Now common stock is an equity account, so it goes in this financing section. And since we received cash, it's going to go as a positive. Positive $30,000. Cash receipt from issuing stock. Okay. And then going down our list, we've got payment of a notes payable. Note payable is a long-term, is usually a long-term. And notice it does down here tell us that in this case, it is for sure a long-term note payable. So since we paid cash, that's going to be a minus $16,000. Cash payment of notes payable. Next, we've got payment of dividends. So remember, when we pay dividends, that comes out of retained earnings eventually. It's close to retained earnings, so that's owner's equity account. So yes, that does go in the financing section. And since we paid cash, it's going to be a minus $9,000. Cash payment of dividends. And then that's it. So what we're going to do is we're going to sum these, and we should get a positive $5,000. So that means from their financing activities, they have $5,000 of cash flow, net cash flow. Okay, and now down here, we're going to have the change in cash, and then we need a beginning and ending balance. So if you look here, here's our cash. Let me use a straight edge. Here's our cash. Looks like cash increased $26,000, so that's a positive. Oops, wrong place. And here we want our beginning cash, which is $12,000. And we want our ending cash, which is $38,000. Now you should double check your sections to see if they are accurate. This 26,000 should also be equal to the sum of the three sections. So 5,000 minus 78,000 plus 99,000 should give you plus 26,000. And it does. And then the last thing we have, so we need to look through our list of data, and we need to find out any non-cash investing and financing. So that's when we get an asset, but we do not pay cash. We financed it with some sort of debt. And that is right here, this $17,000. Let me use my straight edge. $17,000 by signing the note payable. So we acquired plant assets. Acquisition of plant asset by issuing a note payable. And of the 121,000, 17,000 was from financing. In other words, debt. Leave that as a positive. Always leave that as a positive. And we don't have any others. So our total for non-cash investing and financing is $17,000. And that's it.